Hello guys and welcome to today's webinar. Thank you for joining. Got a really good webinar today looking at gold prices and the moves that are happening in today's market. So I've created a really good presentation for you guys as to why I've personally been buying gold. A lot of the members of my service have been buying gold. The markets are buying gold. And I think it's just so important that everybody understands what's going on, because if you do, then we can look to make some really good profits from the moves that are happening. They're actually expected to continue to happen over the coming months, probably even the coming years, because gold actually has been rising for 10 years solid since the 2008 financial crash. And when I explain to you and we go into depth looking at basically the increase in the money supply by central banks and governments, it's going to really become apparent to you that the smart money's been buying gold for a long time. You can even go ahead and do your own research and look at central banks around the world themselves have been buying gold, and they're doing it even to protect themselves from rising inflation expectations. Can I just ask, can you guys all hear, can you guys hear me? If you can, please just send. Okay, good. If you can hear me, that's perfect. So I want to make sure that the sound is good. Perfect. All right, guys. This is going to be a good webinar. I'm going to enjoy this one with you, because after this, you're really going to feel very educated on the whole attractiveness that gold has to many people. So what we're going to do is we're going to start off, guys, with me giving you guys a real understanding for the history of gold, why gold is so important to the monetary system, and why gold has been basically used as the ultimate store of value for nearly 5,000 years, to be honest with you. Since the money system started, gold has been the perfect hedge, should you say, for value of wealth. So what we're going to do is we're going to go over history of gold. I'm going to just break this down for you. Stay with me. We're going to talk about it. I'm going to explain this to you. And then when we get to the end of the video of this whole webinar, and I start to show you gold's moves, I start to show you how much governments are spending, how much central banks are printing, you're going to really start to understand why gold continuously goes higher, why markets continue to look at the interest paid on government debt in the United States. And once you get this understanding, you are literally going to be at the level that investment bank traders are at hedge funds and professional investors, because you'll be thinking at the same level as these titans in the world who are making crazy amounts of money. And it doesn't have to just be them, it could be us. You just have to understand what they understand. And once you do understand it, you can anticipate the moves happening, and you can get a thorough grounding on making yourself a better investor. And that's the whole purpose of this webinar. I wanted to share all my knowledge with you guys, help you guys become better investors, so then you can have a better life for your family and yourselves, and you don't have to rely on paying some stupid pension fund some small amount of money every month, and you retire with some ridiculous amount of money you can't even live on. I want to make sure that while I'm here, I can just share everything I learned, because I'm studying 24/7 and this is my job. So guys, we're going to talk about gold. I'm going to just, I'll read through and I'll reiterate what we cover, and we'll move on to each section. And once we get through the sections, it's really going to start to become apparent what I'm talking about. But just stay with me, be patient. We'll be on here for like 45 minutes to an hour. But by the end of it, I guarantee you, you will be happy with joining this webinar. So let's just talk about gold in history, right? So I'm just going to read through what I've written down. We'll go through the pages, and we'll start looking at charts. We'll start looking at data from the United States about the economy, government spending, inflation expectations, government bonds, why the government bonds are so important for the price of gold. I'm going to show you historical data showing you when bond prices move, how gold moves at exactly the same time, because it's basically a protection against the devaluation of the US dollar, which is happening at the moment in the markets. And yeah, you're going to love it. So let's just start off, guys. So for 5,000 years, gold has been used as a medium to exchange, a medium for exchange. Okay, so before there was paper money, before there was coins, people always exchanged gold. It was always like the ultimate store of wealth. And even when physical gold coins were put into circulation by kings who wanted to create more money in the monetary system, they would even mix different metals with gold to increase the money supplies, for an example. You can go look at this online. It's true facts. And when we go through the monetary supply system, this will all start to make sense. So throughout history, whenever there is more money put into circulation, there is always the issue of inflation, okay? And this is a problem because when you have inflation, because there's so much money chasing a few amount of goods, prices rise, right? That goes without saying. If I am, it doesn't even matter if I'm a musician, for an example, and there's a high demand for my services to perform live, I can charge more money because more people want me. So my price goes up. It's the same with money. Prices for goods and services will increase when there's more money in circulation. So the gold standard monetary system was implemented to try to help stop this problem of inflation. This started around the 1800s and came into the early 1900s before the First World War. And then it started to break down because governments had to increase their money supply to pay for wars. And we're going to touch on this and I'll explain this in more detail. So the gold standard monetary system. So as the name suggests, the term gold standard refers to a monetary system in which the value of a currency is based on gold. So holders of paper money were able to freely convert their paper currency notes into a fixed amount of gold. In this monetary system, gold is backed, the value of money is backed by gold. So back in the day, a paper note, so if I'm showing you a £20 note from the United Kingdom, this was actually a receipt to go and get gold from the bank. So paper money was backed by a commodity, so it actually had an intrinsic value. There was something that gave it the value of £20, for an example, right? And governments were allowed to create a certain amount of paper money that was backed by a certain amount of gold. Therefore, in order to expand the money base, to create more money, the government had to mine new gold, okay? And this was used to keep inflation under control, okay? Because the only way you can increase the money supply is by mining more gold. And as we know, there's only a certain amount of gold. It's quite a scarce commodity, which is why humans have always been so allured and attracted to gold relative to silver and other materials and other metals. There's more other metals in abundance than gold. So gold was quite a scarce metal, and it was quite hard to mine. So when you made sure that the money supply was only being increased relative to how much gold was being increased, then you knew that you couldn't really get that much inflation because you could only increase the money supply if you increased your gold supply, and you had to find gold somewhere in the earth to mine it and create new currencies. So this gave countries the confidence that trade transactions for imports and exports using a country's paper currency, which is easily transportable compared to transportation of gold bars. So let's say you had the United States that was trading with the United Kingdom. Back in the days, they would literally physically trade gold bars for their goods and services. It was literally the medium of exchange. But of course, over time, that became difficult because gold's heavy. So they started to use paper currency. And when paper currency was backed by gold, then they happily took the paper currency because they knew it was backed by a certain amount of gold. And then if they wanted to, they can exchange this paper money for gold. So they knew that the paper they was holding had some value. And if they wanted to, they could then go exchange this paper money with other countries, for an example. But everyone always knew the money's backed by gold, so it had value, okay? And if a country wanted to, they could just go and convert this foreign currency into gold at any time. So they could either hold the paper notes and use it for continuing to transact with other countries and other businesses, or if you really want to, if you're a bit suspicious and you want to kind of make sure you definitely have your wealth, you just go and exchange the paper currency from a bank, for an example, and you get gold. And ultimately, at the time, gold was a safe haven, the ultimate store of wealth, because the currency was always backed by mined gold in the past. Now, this system came into trouble in World War I because governments, of course, had to finance this war when they was fighting the Germans, who were trying to take over the whole world, and they became heavily indebted because it cost a lot of money to run a war or finance a war relative to how much revenue governments were taking through taxes. So they had to increase the money supply, and this kind of caused the gold standard system to break down after World War I. So what they did is they created the Bretton Woods agreement, and this was after the Second World War. And what this agreement was that Western powers met to develop this framework in which the global currency markets would use until 1971. So all national currencies would peg the value of their currencies to the US dollar, and then the US dollar was pegged to the value of gold. So the US dollar, so $35 would buy an ounce of gold, and then every currency around the world, or the big nations, they would peg the value of their currency, like British pounds would peg the value of the pound against the US dollar at a specific exchange rate price. And they would make sure that the exchange rate of the pound against the dollar would never fluctuate more than 1% higher or lower. So it was always fixed around a certain exchange rate. And this meant that you could always exchange your pounds into dollars, and you know your dollars were always backed by gold. So the US dollar became the world's reserve currency of choice, because remember, commodities were all priced in US dollars. So oil is priced in US dollars, iron ore is priced in US dollars, silver's priced in US dollars, and so many other commodities were priced in US dollars because the dollar was backed by gold. So instead of you having to pin your own paper currency to gold, you could just peg your currency to the US dollar, and you knew the US dollar was pegged, backed by the price of gold at a certain price, which was $35, bought you an ounce of gold. So if you had $35 in your hand, US dollars, you knew I have 1 ounce of gold. So this was the new monetary system that came into place. So like I said, by default, the US dollar became the world's reserve currency. And the Bretton Woods system effectively came to an end in the early 1970s when the US President Nixon announced the US would no longer exchange US dollars into gold. And this was really because the US government had to finance the war against Vietnam, in the Vietnam War, and then investors, so the government had to print more money, so they kind of broke their link to the gold standard to enable the US government to be able to afford the war, basically. And what this basically meant is countries who had all this US dollars could no longer exchange their dollars into gold. And then money became a fiat currency system, and the value of money became derived by basically how much currency is in circulation for dollars compared to pounds, for example, and you compare them as a ratio and you get an exchange rate. And now most currencies are freely floating exchange rate in the markets. They can drop and go higher as much as the market sees fit. And this has meant now that we have entered a fiat monetary system. So a fiat monetary system, by contrast, is literally a monetary system where the value of money is not based on any intrinsic commodity such as gold. Its value is based on its purchasing power in its own commodity, in its own economy, and the value of one country's currency when exchanged into another country's currency. So the value of the British pound in the UK is valued in two ways: how much goods and services I can buy in the United Kingdom, and how much US dollars, for an example, can I buy with 1 British pound. That derives the value of the pound. Now, governments no longer have to worry about, you can only increase the money supply by having a certain amount of gold. Now, central banks in a fiat monetary system can create as much currency as they want. They digitally create it on a computer, literally digitally create it in a computer, and they buy financial assets of commercial banks to get money into the system, right? And this is how a central bank will increase the money supply to try to generate growth, or they can withdraw the money supply from the economy to try to slow down spending and control inflation, okay? So a central bank has an inflation target of 2% per year, and that is to make sure the prices of goods and services remain stable and the currency holds its value, okay? So how do they do this? A central bank, like I said, creates the money supply by digitally creating a currency, and then they buy financial assets from the banking system. And what that basically means is, what the central bank will do is they will buy government bonds from a commercial bank, and the commercial banks receive this new digital currency into their computers. They sell these bonds to the central bank, and now a commercial bank has more currency, and then they can lend that currency out to people in the general economy, to businesses, to you and I. Let's say you want to take out a car loan, a mortgage loan, a credit card loan. You want to buy, I don't know, you might want to just do anything with a loan. And if as long as the bank feels that you can repay that debt, they'll lend you the money, and then you pay a bit of interest on top, and that's how the banks make money through the interest on their loans. And if, say, for an example, this increased money supply by the central bank giving this money to commercial banks, and they lend it out, that can help growth. But sometimes you may get high levels of inflation, and if it goes above the central bank's 2% target, they may say, okay, we need to cool down how much spending is going in the economy, and they'll withdraw money from the banking system, or they actually sell government bonds to the banks. The banks have to legally buy them off the central bank, and that reduces the amount of money banks can lend to the general economy. And that basically means less money in circulation, less money is being spent, the demand for goods and services come down, prices can stabilize around 2%, and that's how the central bank controls the money supply through buying and selling government bonds. And that also in turn controls interest rates. So what we need to do now is understand that whenever a central bank buys government debt to increase the money supply, this is inflationary. Whenever there's more money going into the system, it creates inflation. If you get inflation, that means prices rise, and that devalues the purchasing power of paper money, because if prices are rising, you can buy less goods and services for the goods that you're buying with the amount of money you're spending. So this devalues a currency. When you withdraw the money supply, this means that the currency holds its value because prices drop. Now you can buy more goods and services with the money that's in circulation. So what this basically does is this moves us on to government 10-year treasury bonds. Now this is such an important government security, and basically this is why gold prices are rising. Once we go through this whole analysis, you're really going to start to wake up and see what's going on. And then you're going to understand why gold is forecast to continue rising for a very long time, because gold since 2008 has been rising for 10 solid years. And now they're pumping even more money than 2008. So gold is expected to continue to rise. And we should expect this bullish gold momentum to continue. Okay, so let's look at the treasury bond, and I'm going to explain to you why the government's treasury bond is so important. And I'm going to explain to you what a treasury bond is if you do not know. But by the end of this video, it'll be so easy for you to understand. You can even explain this to other people when you have a conversation. So why does a government issue bonds? Why would a government sell a bond? What is a bond? Okay, so if a government basically has to spend more money to run their economy than they're receiving in taxes, then you have to raise money to plug that shortfall. So let's say I have to spend £100 billion to run the UK economy, but the government only receives 90 billion in taxes. Well, then there's 10 billion shortfall. So what do? You issue a bond, and a bond is basically a contract that says, if you lend me £100, for an example, for 10 years, I promise to repay you your £100 back plus interest. All right, so let's say the interest on that's 2%. I promise to repay you £102 in over 10 years, over a 10-year period. Okay, so investors will say, all right, cool, I'm happy with that. That's the interbank rate, but a bond rate may be a fixed amount of interest. So the government may say, okay, so if you lend me £100, I might pay you £5 every single year for 10 years. Okay, now that's called a coupon payment. And basically investors will lend the government this money, and every year they're receiving 5% interest, which is £5 of the money they've lent the government, and they're making a profit on their money. Then after 10 years, they get the money back, and the government's been able to continuously borrow money to continue to spend in the economy because they're not receiving as much taxes. They need to borrow the money from somewhere to keep the economy growing. So government debt or a treasury bond is seen as the safest investment that any investor can buy, because it's backed by the government of a country, and the government of a country should never default on their debts because they should be very sensible in how they manage their finances, and they have the ability to raise taxes to always get the money they need to pay off their debts. Okay, so a 10-year treasury bond is basically a government security that the US government uses to borrow money from investors, and they promise to repay a certain amount of interest back every single year on the money that they're borrowing. So as the US is the world's largest economy, the US treasury bond is seen as a risk-free asset, as it's backed by the US government that has the ability to raise taxes to always meet its debt repayments to investors. Okay, so let's go over this. Let's say the government sells a $1,000 10-year treasury bond paying 5% interest each year over 10 years, okay? So the investor will receive £50 US interest every single year for 10 years. Okay, and that's 5%. And then the bond's price will fluctuate on an open market where you can buy and sell bonds to other people. And the price of a bond fluctuating will basically be derived around the supply or demand for bonds. So let's talk about the demand for a bond. Just stay with me. You'll be able to get this video after. You can watch it back. Just get an understanding of what's going on. And then when I explain to you the further down the line, it's going to make a lot of sense. So if, for example, there's a high demand for bonds, right? Let's say people really want these US Treasury bonds. People want these bonds. They feel like the risk of the US government not repaying their debt is very, very low. They want to hold these bonds. They know they're going to get interest on their money. They'll lend money to the government. Okay, so people have a high demand for bonds. Remember, whenever there's a high demand for anything, prices rise. So if the price of the bond rises, but the government's still paying that $50 interest every single year, the interest on that bond actually goes lower. So let's say now the price of the bond goes to $1,200. You bought the bond for $1,000. The price of the bond has gone higher to $1,200 because everyone wants these bonds, so the price rises. Now your $50 a year that the government's paying you is now 4.16% compared to 5% when it's paying you $50 on $1,000 bond. So you can clearly see if the price rises, the value of interest you're getting goes lower relative to the price of the bond. So any new investor that buys the same bond is now only receiving 4% interest on the debt over 10 years relative to the investor who owned it at the beginning and was getting 5% interest. Now, let's say there's a low demand for bonds. Let's just say for whatever reason, people don't want to buy bonds. They'd rather buy stock markets because they're going to get a better return on their money. Let's say the bond's price dropped from $1,200 down to $800, but you're still receiving that $50 coupon payment every single year. Now $50 divided by 800 is now 6.25% interest. So any new investor that buys that bond is now getting 6.25% interest. So you can clearly see that if bonds have a high demand, the price of the bond will rise, and that coupon payment that the government's paying every single year will drop in terms of how much that is as a percentage of the bond's price. And when the bond's price drops, that coupon payment is actually now a larger percentage of the bond's value. So you can clearly see if bond prices go up, interest rates go down. If bond prices drop, interest rates go higher. Now, also the supply of bonds can affect the price. So if the government wants to increase its spending, it can either reduce its spending or borrow more from investors, and they can issue new bonds, sell these bonds in the market. And because there's now a huge supply of bonds going into circulation, that could devalue the bond's price. And again, that could make interest rates go higher. Or if there is a large decrease in bonds, for an example, the bond's price could drop. So the point I'm making is supply and demand of bonds will affect the bond's price, and that will affect the interest paid on the bond by the government. Now, why is this important? Why is this 10-year Treasury bond yield, and the yield basically means the interest paid by the government, why is this so important to investors, and why is this affecting the value of gold in the markets? Now, remember, central banks' mandate is to make sure that you have 2% inflation target in an economy, okay? So the central bank's mandate is to make sure that you have 2% inflation, and they will increase and decrease the money supply to maintain a 2% inflation rate. And like I said, the central bank will inject money into the system and withdraw money from the monetary banking system using interest rates to make sure that inflation is at around 2%, and they create the environment for banks to lend money easily or make it more difficult for banks to lend money because people may not want it with higher interest rates, for an example. And this is all to do with inflation. All of this is to do with maintaining inflation around 2% to make sure they keep their mandate of 2% inflation, okay? Now, what's happened since this 2019 COVID pandemic is governments have shut down vast amounts of their economies as the COVID-19 outbreak has spread all around the world. And this has meant that governments have had to increase their spending and lend money to businesses and households to make sure that people have money, because people can't go to work, they can't travel, they're restricted into their house if they're on quarantine, for an example. And government spending has increased because governments are giving loans to companies, they're giving grants to companies to make sure they don't lay off workers and cause mass levels of unemployment that will cause huge problems for an economy. They're giving tax cuts to businesses to make sure that businesses have enough money to pay their workers or get back on their feet when this whole situation passes, if there's a vaccine fast enough. They're paying benefits. In Europe, they're paying furlough, so they're paying 85% of people's wages to make sure that employees don't sack people because they don't have to pay their wages. The government's covering that cost for them. And this is very, very, very expensive. The government has to pay all this money out to help the economy keep ticking over. But at the same time, the government, whilst it's doing that, has drastically increased its spending, but is now receiving less money, because now they're receiving less money in taxes because people are not working. They're giving all these grants. They're trying to maintain high levels of spending to keep growth in the economy growing. And they're making people in a situation where they can support themselves. But now they're receiving less money, for an example. So now tax revenue for governments has decreased drastically as spending has increased. So more people unemployed would mean reduced tax revenue. If less money was being spent in the economy, businesses would be earning less money, and the government would receive less money on VAT, for an example. Businesses' profits would drop, so less corporate tax revenue for governments. So the governments have had to keep lending money to businesses and businesses and people to maintain spending to help the economy. But at the same time, the government's now receiving less tax revenue. But remember, the government has to pay for all this stuff. Where are they going to get this money from? How are they going to raise all this money if they're receiving less taxes, but they have to increase their spending? So governments have had to borrow more money through issuing new bonds into the market to finance this deficit. Remember, their spending has dramatically risen, but their income has dramatically dropped. How are you going to support that situation? You have to increase your debt. You have to issue new bonds. And as we looked at earlier, remember, when you put more bonds into the market, you cause a situation where the price of the bond drops, but the interest rate goes higher, okay? So who's gonna finance this government debt? It's the central bank, and this is called quantitative easing. Now, what this is, remember, central banks can only buy financial assets. They can't give you and I money in our pockets. They have to buy financial assets, such as government bonds, and then they leave it up to the government to how to spend that money to help the economy grow and continue a healthy environment for people within the economy. So central banks have been directly buying governments to finance these large deficits. So the central bank is now buying these government debts. Now, remember, when there is a high demand for bonds in the market, what happens? The price of the bond rises and the interest on that bond goes lower. Remember, we looked at earlier, if you're getting $50 on that $1,000 government bond that you bought, if the price goes up to $1,200, as we looked at, you're now receiving less interest. The interest rate on that bond has gone lower, okay? And this is helping the governments get money directly from the central bank. Now, you could say this is a bit suspicious. How could the government owe money to a central bank, but the government is in control of the central bank because they elect central bank governors, and the central bank has to answer to the government. So it's a bit suspicious what's going on at the moment. They've been saying this for a very long time. You can do your own research and make up your own mind about this, but that's effectively what's actually been happening at the moment. The central bank is financing the government to pay for this debt that the government has to borrow, otherwise the economy will collapse. And this is being seen as very, very suspicious. So this has resulted in the treasury yields, and the yield, as I said, means the interest rate on the 10-year bond to decrease due to the high demand for bonds created by the central bank by buying this newly issued debt. Now you can see the money supply has increased dramatically by the central bank since 1980 to 2020. Here is a long-term trend line, and since 2008, you can see the money supply has dramatically increased way above the average trend line in the United States. So this has increased demand for bonds created by the central bank, And at the same time, inflation expectations are rising because these massive amounts of money being injected into the economy by the central bank, what does it do? It creates inflation, okay? So now there's a problem, because if you're an investor, remember, you're an investor. Let's say you're a business, you're Apple, you're Microsoft, you are a business that has huge amounts of cash revenue. So like you have $200 billion sitting in a bank account, right? For an example, you're holding these dollars. You know the central bank's pumping all this money into the system to try to save the economy. And now you know that inflation expectations are going to rise, okay? Because all this money is coming into the system, it's going to raise inflation expectations. And if inflation keeps rising, then the value of your money per year will continue to go lower. If I hold £20 and there's an inflation rate of 2% per year, I lose 2% value of this £20 purchasing power every single year that I hold this £20. So investors historically want to buy something that gives them at least 2% protection or 2% interest to protect themselves against the inflation expectations, okay? What are they gonna buy? They're gonna buy gold, okay? Gold's always been the intrinsic store of value. It's always been the hedge from a fiat currency from time they came off the Bretton Woods system in 1971. So investors, historically, I'm going to explain this now to you in more detail. Investors usually buy government bonds as a hedge against inflation. That's the way they do it. Investors always just buy a bond if you want to protect yourself against inflation, because usually a bond would pay you at least 2% interest. It was paying 2% interest earlier this year until the central bank dramatically cut interest rates soon as this pandemic hit the global economy. So if the annual rate of inflation is 2% and you buy a 10-year government bond that pays you 2%, then your value of your money is protected. You have enough interest to protect you from the inflation, and you could sit on that 200 billion if you're Apple or you're Microsoft, and you know that the value of your money is protected if you own government bonds, because it's paying you enough interest to cover that inflation rate of 2%. So businesses and individuals who just want to maintain their purchasing power of the cash they hold, they'll buy bonds usually. However, what happens when the bonds yield, the interest paid on the bond, no longer pays you enough money to cover the 2% inflation rate, or expected higher rates of inflation now that the central banks are pumping this huge amount of money into the system? So look what's happened since the 1980s. Interest rates in the 1980s used to be 15%. They've now dropped continuously, and now they're paying at the moment 0.69%. If I buy a 10-year government bond today, the government will pay me 0.69% interest on the money that I lend to the government. Now, if inflation is rising at 2%, I'm now losing 1.4% for each dollar I hold. Its value is going down by 1.4% every single year. Now, what if inflation is expected to rise even higher? What if it goes to 5%? I'm going to be losing 3.5% or more than that. I'll be losing 4.4% of my dollar values every single year because of high levels of inflation. And with the US government now pumping, I think it was 3 trillion they're going to be pumping into the US economy. The central bank's already pumped around 2 trillion since the pandemic started in March of this year. That's a huge amount of money. That's never been done before in history. Not even in 2008 was that much money pumped into the system. This is an enormous amount of money the governments and central banks are throwing at this pandemic to try to make sure the economy can stay alive. And I'm going to explain to you why they have to do that. Otherwise, the government may not be able to raise enough money through taxes to pay their debts. And if the US government defaults on their debt, the whole monetary system comes to an end, because the US is the world's leading economy. Don't raise your hands yet, people. Just wait until after the presentation, and I'll answer any of your questions that you have. So that's why bond yields are so important. So why has the bond yield been falling for 40 years? Since 1980, why has the interest paid on government debt gone from 15% to now 0% effectively on a 10-year treasury bond? It's because of government deficits. Now I'm going to show you some really good information looking at the US economy. This is quite advanced. This is what I teach on my advanced Forex course that explains this in more detail, but it's really important you understand this, because once you understand this, You're going to get an idea as to why gold's been going higher for 10 years and why it has to continue to go higher, because investors need something to protect the value of their dollars against high inflation. So the US has been spending more money than it receives in tax revenues for a very long time. It's been doing this for nearly since the 1960s. So every single year, the government's spending more money to run the US economy than it's receiving in tax revenue. So every single year, the government's issuing bonds and they're selling bonds to investors to raise the money, and they're spending that money. And every year they're borrowing more and more and more and more. And the debt level is growing higher and higher and higher to finance this deficit, okay? And this has led to a huge increase in national debt from past borrowing, okay? So now at the moment, the US government has borrowed over $23 trillion since 1960, okay? That is an enormous amount of money that the government has to pay back. But remember, that's how much they have to pay back, but they have to pay interest on that debt, okay? So for governments to maintain full employment, to maintain a growing economy, to continuously get re-elected by the people, if you're the Republicans or you're the Democrats, you have to keep spending to make sure the economy keeps growing, to show people we can do a good job at maintaining the economy and increasing a better situation for your livelihoods. So you have to keep spending. If you cut spending, then the economy will start to decrease, because once you get to a point where government spending has become such an important driver for the economy to grow, you have no choice but to keep spending even more every single year just to maintain that growth. Otherwise, the economy starts to shrink. And once we look at the debt to GDP ratio levels, you'll start to understand, and I'll put a question to you. If you were to lend money to someone, would you lend money to someone who has more debt? They owe more money than they receive in revenue. Would you give that person money? No. Well, you could lend that person money, but what would you do? You would charge a higher amount of interest, okay? Now, this is where the interest payment has to be suppressed by the central bank to help the government borrow this money, to help the government spend. And they're stuck in this cycle now where the government actually can't cut their spending. They have to keep borrowing money, keep spending money to keep the economy growing, because they've now got the debt level at such a high level that they can't cut the spending. Otherwise, the economy will start to decrease. And then that will mean less revenue for the government, less taxes, less chance of repaying the debts. Then investors will maybe stop borrowing money to the government because they're suspicious that they'll even get their money back. And that causes a whole other problem. And basically, the central bank has now financed government debt. So the government is now basically being financed by its own central bank that it owns. And that's where the suspicion comes in now about what's really going on here. And is this monetary system really starting to get on shaky legs? So past borrowing has contributed to growth in the economy, keeping prices at 2% inflation, helping maximum employment in the economy. The government, again, must maintain its spending to keep the economy growing. But remember, the government has to repay this debt. So let's say the GDP value of the US economy last year was 21 trillion. The total amount of government debt, so from past borrowing caused by having to borrow money because of these deficits, because they're not receiving as much money from taxes as they're spending, their borrowing is now 23 trillion. Take that into perspective. The economy produces 21 trillion worth of goods and services every single year. That's what gross domestic product is. The total value of everything produced in the United States is 21 trillion. The government has borrowed 23 trillion. It owes more money than it even makes in its own economy. Okay. So if you was an investor, would you borrow money to a person at low rates of interest if they owed more money than they actually make? No, you wouldn't. You would charge higher rates of interest. That just goes without saying. If you came to my house, knocked on my door and asked me to borrow me £1,000 for an example, if I think the risk of you not paying my money is very low, I'll give you the money and I'll charge a lower amount of interest. If I'm suspicious that you can't repay the debt, I'll charge a higher amount of interest to compensate me for lending money to someone who may not repay me. So I want to be compensated for that risk. I'm lending you money. I don't have to, but if you want me to lend you money, because you're a risk, I'm going to charge you higher amounts of interest. Now, therefore, for the US government to borrow money at low rates of interest to maintain GDP growth, to maintain maximum employment, to maintain the economy stabilizing and keeping inflation at 2% because there's a high demand, there's an average amount of demand for goods and services, the central bank now must keep buying the government debt. Because remember, when the central bank keeps buying the government debt, it's raising the price of these bonds. And as the bonds price rises, the interest rate continues to go lower. And basically that's allowing the government to continuously borrow in order to have enough money to spend and to repay its debts, to afford repaying its debts and to continue to borrow at low rates of interest. And basically this allows the governments to keep borrowing money and running a deficit in their taxes, because then, as I said, they're receiving less money from tax revenue than they're spending. So the central bank buying this government debt is basically allowing the government to continuously borrow money at low rates of interest and continue this deficit spending to maintain growth. But the government has no choice. It has to keep borrowing. Interest rates have to continuously stay low because the risk of default is now too high. Look, 107%. That's the debt to GDP ratio. The government owns more debt than it even produces in its own economy, 107%. Okay? So what does this mean? This basically means that with governments that have 100% debt to GDP ratio, historically, going through history, going back hundreds of years, this has led to defaults. And when a country defaults on its debt and investors get scared that they're not going to receive their money back, they will literally charge ridiculous amounts of interest on that money. And the government will then find it even harder to repay money, even harder to raise money to repay debts, because they're now being charged these astronomical interest rate levels. And this is why once you get past that 100% zone, defaults become very, very frequent. Argentina did it. Greece defaulted on their debt in 2015. That caused a European debt crisis only 5 years ago. And it's very, very dangerous. So above 80% debt to GDP has historically been problematic for governments, and levels above 100%, you really start to see defaults happen, okay? And remember, at this moment in time, the US government and central bank is pumping all this money into the economy, okay? And they have to do it to maintain growth. But what does it do? It leads to higher levels of inflation, because when you put more money into a system and there's a high amount of money being injected into the economy. So right now the central bank is buying corporate debt. They're basically giving companies money. Same in the UK right now. And they're paying people's wages. And they're pumping all this money into the economy. Prices are expected to rise. It is the laws of inflation. If you increase the money supply, inflation rises. It happens all over the world. Look at Venezuela at the moment. Inflation has gone up like 1,000% or something ridiculous. They put so much money into the economy, it's caused high levels of inflation, okay? Now, the government actually has to create inflation now to be able to afford to pay off this debt. Think about it. Higher levels of inflation in prices means that prices rise, and as prices rise, companies will be making more profits, for an example, and the government can actually tax more from that rise in prices. So let's say the government has a 20% corporation tax on all profits in a company over an annual period. Let's say inflation rises and now Apple phone goes from $1,000 to $1,500. Well, the government's 20% tax is still 20% tax. So now the government's actually going to get more tax revenue when you get high levels of inflation. And this means more revenue for the government to repay its debts, and it reduces the debt to GDP ratio and helps the government repay its interest payments. So think about it for a second. They call it inflating their way out of debt. That's what this is called. Okay, governments can't reduce their spending because it leads to lower levels of growth, lower levels of inflation, less tax revenue, and investors will demand more money in compensation for lending money to the government. So what the government, this is what they in Italy keep talking about, inflating your way out of debt. They basically say, well, why don't we just spend so much money that prices continuously rise? And as prices continuously rise, that's more revenue for the government, and the government can use that revenue to pay off its outstanding debt, meet its interest payments, and reduce the debt to GDP ratio, because if the value of the economy keeps rising because of high levels of inflation and it just rises at a faster rate than debt levels, then it can basically try to get the debt to GDP ratio under control. And how they're going to do that, the central bank financing this money is going to be the key player to helping the government get out of this mess, okay? So now we are investors. We want to protect our money against inflation. We don't want the purchasing power of our pound to go lower. We want to protect ourselves. We want to be smart investors. What are we going to do? If the US dollar, which is the world's reserve currency, remember, central banks all around the world hold huge amounts of dollar reserves. What if you're a central bank and you're holding on these dollars and now your dollars are devaluing because inflation's rising? What are you going to do? You can't buy 10-year government bonds anymore. You're only getting 0.69% interest. You're still losing 1.4% value of every dollar you own. What do you buy? Gold. Gold becomes, again, the last resort in terms of an intrinsic value when the fiat monetary system starts to get into trouble. And this is what's happening. The US economy, the UK government, the US government, their debt levels are now getting astronomically high, and they're having to pump all this money into the system just to keep the economy going. Inflation expectations are going to be rising even higher. Investors have to buy something. They're buying gold. Gold is an ultimate safe haven, okay? Gold is up 276% since 2007. And I'll show you right here. Since 2007, let me take this to a weekly chart to show you guys. Since 2007, if I move back, look how much gold has risen in price. For 10 years, gold has continuously gone higher. 264%, if we get it correct, let's get it to the right levels. 267%. 267%. If we do that per year, what is that average? The average is around 20 something percent, right? 267 divided by 13 years, sorry, not 20 years, 13 years. Gold has gone up 20% every single year since 2007. And what happened since 2007? Why don't we have a look? Just what I showed you guys earlier. How much has the government how much has the US central bank been spending to keep the US system afloat? Well, I showed you the chart earlier. You saw that chart I showed you. The government's money supply has drastically increased. Look, as I said, look since 2007. Look at the money supply. It's gone way above the average trend line. The money supply has dramatically increased. And no surprise, as the money supply has increased, gold's up 267%. And why is gold up 267%? Because the 10-year treasury bond has continuously gone lower because the US central bank is basically financing this deficit that the government has to continuously run to save the economy. So let's look at this for an example. This is the US 10-year treasury bond highlighted in blue. This is the price of gold highlighted in red. Here's the 10-year bond, as you can clearly see here, minus a 2% inflation rate. So you can see we got 8.1% bond yield. So how much the government's paying on their 10-year debt, minus 2%, right? Since 2008, the bond yield has continuously gone lower. The interest rate on the bonds that the US government is issuing has continuously gone lower. It was paying 2.25% in 2008, and now it's paying, once you adjust it for inflation, minus 1.5%, as I was saying. So now your US 10-year government bond, the yield, the interest paid on that bond continuously goes lower because the US central bank continuously buys government debt. It continuously pushes up the price of a 10-year government bond. It lowers the interest rate so the government can continue to borrow money at low rates of interest. And what happens? Investors no longer have a hedge against inflation. What do? They buy gold. And that's why gold's price has continuously risen for 10 years solid. And look at what happened this year. In 2008, in 2020, we can see, or 2018, sorry, we can see now interest rates in the United States was going down in 2018. In 2018, the central bank started to slash interest rates. What happened? When you cut interest rates, you're lowering the amount of interest investors get on their government debt. So the interest kept going lower. Look at gold's price, shot up dramatically since 2018. Let's look on the chart and I'll show you right here. Since 2018, we can see gold's price started to rise dramatically because interest rates were going lower in the United States. If interest rates are going lower in the United States, gold automatically becomes the choice. You have to buy gold. Otherwise, your US dollars are losing value every single year. What else are you going to buy? Okay. Now, if you buy gold, on the other hand, and gold goes up by 70%, you've more than protected yourself against that 2% inflation. You've made a 67% return on your money on the amount of gold you've bought. So everybody's selling US dollars and buying gold. And remember, gold is priced in US dollars. So gold's value is continuously rising. Now, as I've already shown you guys, the government has to keep borrowing, to keep spending, to keep the economy going. The debt levels above 100%. They don't have a choice. They have to keep spending to maintain inflation. They're talking about inflating their way out of debt. What does inflating mean? Higher inflation. What does higher inflation mean? The purchasing power of the dollar continues to decrease. If the purchasing power of the dollar continues to increase, what the dollar is the world's reserve currency. People don't want to hold dollars. They need something else. They buy gold. Again, it goes back to 5,000 years. Gold's always been the store of value. And that's why gold is now on this bullish trend. So now you understand that, guys. You understand that the US government's pumping trillions into the US economy, literally trillions right now. The US central bank is pumping trillions into the US economy, buying all this debt, basically lending this money to the government, saying, you go spend this money however you see fit, keep the economy going. But that's decreasing the 10-year government bond yield. Investors have to keep buying gold. If gold's been doing this for 10 years since the financial crisis in 2007, what makes you think now that they're increasing money at a 5 times higher rate than it was in 2007? Look at 2007. Look what happened in the financial crash. Literally, look at that increase in gold. Look, that was literally just boom, continuously went higher. And what do you see again? Gold keeps going higher. Gold is the safe haven. You protect your US dollars. You protect the value of your US dollars by buying gold. All the smart money is doing it. Go online after you finish this webinar and look at central banks buying gold. Look how much gold the Chinese central bank's been buying. Look how much gold the Russian central bank has been buying. Why? Because China's been historically buying US government debt for years. That's why they say China owns the US. I think it's like 60% of US government debt is owned by China. But now when they're seeing the US dollar losing its value because they're going to be receiving less government debt, what are you going to do? You're going to buy gold. You got Chinese central bank buying gold. The Russian central banks are buying gold. The UK central bank's buying gold because the US is the world's reserve currency. And if the US is losing its purchasing power, you need to protect that risk. You've got huge amounts of US dollars you're holding. You've got to protect that risk. So investors buy gold. Okay, this is what's been happening. This is the signals I've been sending to my members. We're making really good profits. This has been happening for 10 years. Okay, now for the next 10 years, what do you expect is going to happen? Do you think gold's going to drop in price? Well, unless the interest rate on government debt goes back above 2% to protect themselves against inflation, investors are not going to be buying US government debt. The central bank has to buy it now. Why is central bank buying it? Because no one else is going to buy it. Why would you buy a government bond that pays you 0.69%? What kind of interest is that when you know inflation is probably going to go maybe 3% or higher? What are you going to do? You're going to buy gold. And that's why gold at the moment has been rising dramatically since 2018 when the central bank in the United States started cutting interest rates, or sorry, the beginning of 2019 and the back end of 2018, gold's been rising. Whenever you see this, this happens. I could even show you the euro when exchanged into gold, exactly the same situation. In 2018, the European economy started to struggle. The European Central Bank started to reintroduce quantitative easing, suppressing the interest rate on 10-year bonds. What does The price of gold, when you exchange euros into gold, look what happened with the euro. The price of gold, when you exchange euros into gold, gold has rallied against the euro. Same situation, I can show you right now. Gold has rallied against the euro. All these central banks are buying government debt, reducing the interest on government bond yields. If you own euros, if you own dollars, if you own the British pound, again, I'll show you the same situation with the British pound. Gold has been rising against the pound. Sorry, gold priced in pounds. Aussie dollars, same situation. New Zealand dollars. Oh, sorry. Oh, sorry. Yeah, here we go. New Zealand dollars. Gold's on the rise. Gold is the thing you need to be buying right now, okay? At the moment, gold is the hedge. That's how you protect yourself. You buy gold, okay? Now, guys, if you are interested in joining my service, my premium service for my members, if you want to take a course to learn this in even more detail, this is the service that we are providing. So we have every single day live analysis put into the markets. I'm giving you videos explaining to you in detail so you can understand what the hell is going on. Okay, you can watch these videos. You can get a really thorough understanding of interest rates. You can understand what's happening with the Japanese yen throughout the day, with the euro, trading opportunities in the markets. I'll be explaining to you why the Turkish lira is going down in value, what's happening with the emerging market currencies, why stock markets are moving higher, why I'm buying gold or other assets. And you can literally follow my analysis for free. This channel's free. And then if you want, you can join my premium service where you can pay a price for my signals and analysis. You get to follow my trades, and we have a membership support team who answers any of your questions throughout the trading day. Every single day you have someone available to answer your questions. So we'll be looking at the euro, we'll be explaining why the euro was getting weaker over 2 years and why it's expected now to get stronger against the US dollar. We talk about stock markets, talk about gold prices, oil prices, so on and so forth. So that is the service that we provide. Personally, yeah, it's good to follow analysis. Yeah, it's good to follow my positions in the markets, but you should really educate yourself and learn how to take advantage of these moves or educate yourself in a more advanced way. And that is the way of courses. I'm actually doing a live course in a couple of weeks online. I have 100 spaces available. So if you're interested, you can inquire about that. But if you've got any questions, guys, I'll be happy to take some questions from you guys now. Some people said my screen was frozen. Has it unfrozen or is it still frozen? I had no idea. Is that still working or what's happening? Okay, guys. I'm going to try to sort out this problem. I hope the whole video didn't freeze. If it did, that's very frustrating. But anyway, I'm going to save this video, upload it to YouTube, so you will have the material available to watch back on. Guys, thank you so much for joining. I really appreciate it. I hope you had a good weekend. And we'll be doing more of these webinars more often. So thank you very much, guys, for joining. Take care and have a good weekend.